Right. So now that the shocking figures of unemployment are hard to come by, as some analysts had expected the situation to remain stable, various sectors of the economy continue to shed jobs, which poses a risk, a vicious cycle of unemployment and poverty. So to help us analyze the latest figures, we are joined by Nadir Thokan, who is investment strategist at 274 Investments. Well, this came as a shock to many people this morning. The figures, did they really shock you?
Yeah, not all that much, Colin, unfortunately. This is the unfortunate reality that we've had to come to live with in South Africa. The bottom line is that investor confidence, consumer confidence are at multi-decade lows. There is zero investment in the South African economy, or investment at least is very scarce within the South African economy. And our own corporates have been investing offshore at a prolific rate, so a lot of the time to their detriment. But the bottom line is that with very little opportunity to invest in South Africa, with zero growth, that's not an environment that's conducive towards job creation. We've got a number of items that's weighing on business confidence, and ultimately that's impacting consumer confidence and impacting the ability for consumers to increase their spending. And let's not forget that about 60% or just under 62%, in fact, of South Africa's economy is driven by consumption. So with very low consumer confidence and very low fixed investment, these numbers really can't come as a surprise. Some of the matters that we're dealing with at the moment, we've got Eskom has recorded a record loss of 20.7 billion rand. They're receiving a further in excess of 100 billion rand of government bailouts over the course of the next 3 years, with really no plan to turn the situation around. Ratings agencies have put us on notice with regards to this Eskom bailout. We've seen Moody's has said that this is definitively credit negative. Fitch has downgraded our outlook from stable to negative, and we're really seeing an economy battling to really get any kind of growth going domestically. This is notwithstanding the fact that, if you sum up, all the wasteful and irregular expenditure out of municipalities, we could basically cut our budget deficit in half. So this is really not an environment which is conducive to attracting foreign direct investment, and the economy is feeling the pain of this. So the mandate on government is very clear. Have clear policy directives, create a conducive environment for creating business spend. No one is saying that wasteful and irregular expenditure is going to zero, but the fact that wasteful and irregular expenditure at 120 billion rand is half of our budget deficit, that's a shocking statistic. So we really need government to get the finances under control, redeploy the scarce resources that we have in terms of the taxes we're collecting into constructive avenues, and create an environment which is conducive for business investment to follow, which will spur consumer confidence, and that's the only way we bring the unemployment rate down.
I really would like us to unbundle the push factors regarding why business is so much under pressure to shed jobs. When you look at sector by sector, the banking industry, for example, has been shedding jobs locally and internationally. And also when the country is bracing itself for investment to cascade into the various sectors of the economy where you can pick up on the numbers, they seem to be going down. Just put us through those indicators of job losses in terms of whether or not they could have been put on hold to wait for confidence to come back.
So look, I think it's kind of the cycle of companies are under as much pressure as everybody else. The bottom line is that they report numbers on a quarterly basis, and if they report strong earnings declines, it becomes a very difficult trading environment for them. We've seen volumes and values have been sucked out of the JSE like a vacuum, and if there's any kind of earnings disappointment or disappointment to the market, we see shares being hammered. We saw that in fact with Massmart earlier today. They've indicated that they're swinging into an operating loss after the second half of this year was worse than what they expected, and the shares are down 26%. So the point I'm making is that if you disappoint in this environment, the market is hammering you in what's a very low liquidity environment. So the reality is that a lot of these companies are choosing to run leaner, meaner operations, and in the absence of being able to grow the top line with regards to revenue, because there's zero confidence confidence and no investment happening in this environment, in the absence of that kind of top-line growth, the only way they, deliver the earnings that the market is looking for is by gaining efficiencies, cutting costs out of the business, and the reality is that means further job losses. We saw yet another company, AECI, just the other day reporting their half-year results, and we saw that they incurred 156 million rand restructuring cost. Essentially what that restructuring cost means is that they're cutting jobs and they're restructuring their business to be able to operate on fewer people, and that's ultimately just more job losses that are coming through. One feels some kind of sympathy for these companies, because the reality is that they disappoint the market, the share prices get hammered, and in the absence of being able to grow the top line, unfortunately improved efficiencies and job retrenchments are the only options they have in the short term. Long term, yes, they can invest more, but there needs to be a more conducive environment from government, more conducive environment in terms of policy certainty, where we're going with Eskom, those kind of things, to be able to unlock that investment.
While we are on another one bites the dust kind of scenario, there seems to be news that is not all doom and gloom in some sectors. For example, community and social services recorded the largest employment gains, 28,000 jobs, manufacturing 18,000, as well as utilities at 6,000 in the same period. Yeah. So when you are having the green arrows pointed upwardly, what does this mean in this subdued economic environment?
Yeah, look, I think we've got to take the gains wherever we can. What's very clear from the numbers is that the informal sector is creating jobs at a lot more of a rapid rate than what the formal sector is. That is somewhat encouraging, but it's being more than offset by the job shedding that's happening in the formal sector. The mining sector obviously continues to cut back production. Still the scars from 2015, the low commodity environment is still very fresh for these guys. So, they're still managing their balance sheet very efficiently. As you mentioned, the banks retrenching, MultiChoice retrenching 2,000 people. The kind of job losses that we're seeing in the formal sector is more than offsetting what we're seeing in the informal sector. And the reality of the situation, yes, we've got to take the positives where they come, but we've got to address some of these structural issues within our economy.
In hindsight, I wanted to ask you about what's pumping up these numbers. I see here StatSA is using the margin of 16 to 64. Are these numbers not really exaggerated when you start at the age 16? Yeah. Shouldn't we be looking at the way age progression goes? From 16 to 19, we assume that young people could be at school. Yeah. And when from 19 to say 23, you're still at tertiary education. Yeah. So from 24, and you wouldn't even use 64 because that's a retirement age. Yeah. So why would we have unemployment statistics really taking from a margin of 16 to 64 years? Yeah.
Look, so there's probably an argument to be made on the lower end of the band in terms of increasing it because of school age. In terms of tertiary education, the reality is that in South Africa, tertiary education is a luxury. The majority of people don't go and receive tertiary education and probably do have to enter the workforce immediately after work, or rather immediately after school, if not before that end date. So I think it's just kind of a reflection of the reality that we live in South Africa. The one point that you can note from the unemployment statistics is that the participation rate did increase by 1%. So basically another kind of 160,000 people entered the job market, and we obviously didn't absorb those jobs. So look, at the margin, when you're talking about 400,000 or 450,000 people having or less, 450,000 less people employed than there were a quarter ago, that kind of marginal difference of 100,000 people is not going to move the needle here or there. I think those are just technical arguments that's going to move the needle at the margin. The reality is that South Africa does face a jobs crisis. We do have an unemployment crisis, and if we don't turn investor confidence around and deal with the major structural issues towards the economy going forward, this is going to become a catastrophe, and we're going to see the long-lasting impact on the economy for many years to come. The ratings agencies have already indicated that they're kind of running out of patience with South Africa. Moody's, in all likelihood, is going to downgrade us at November. Fitch could potentially potentially downgrade us further into junk territory, if we don't get our act together. So the bottom line is that we are out of road here. Having an academic debate about 100,000 jobs here or there between 16 and 19 or 64 is really not the point. The point of the matter is that, we have to get economic growth going again. We have to collect more taxes, and government has to spend that tax more efficiently in order to see South Africa becoming more prosperous.
All right. Thank you very much for your time.
Yeah, it's a pleasure. Thanks for having me.
Nadir Thokan is investment strategist at 27 for Investment, and of course focusing on to other